Hey YouTube faithful, Heavenly Prepper here. I wanted to put together a quick video today to just talk about a couple things. And I titled this video, If Not Silver, Then What? Silver Pays No Dividend. So we're looking at Kitco forums right now, Kitco Online, and you can see silver's at 22.26. You've got a gold silver ratio of 61.1. These are some crazy numbers. Silver's gone down. And quite frankly, that makes me more bullish because I get to buy more ounces when the price goes down. But people get scared sometimes with these price drops. And I just want to talk about, if you're not going to put your money in silver, where else would you put it? So let's talk about a couple of options. I've already talked about real estate. Let's talk about treasuries. Safest possible place to put your money, or that's what the government will tell you. What are you looking at? So this is from the Treasury website. If you want to tie up your money for 30 years, you'll get 3.09% interest. That's not a big number. And that's a long time to tie up your money. So if interest rates go up, your money goes down there. If you want to sell the T-bill, you can hold on to it till maturity and make that 3% the whole time. But let's say you only want to tie up your money for 10 years. Well, you're making less than 2%. Less than 2%. Less than the rate of inflation. And if you look at shadow stats, obviously it's way less than the rate of their inflation. 5 year, you're under 1%. So you have to tie up your money for 5 years. You're under 1% for a treasury. You're basically paying somebody to lose money. That's what's happening, because inflation is definitely over 1%. And you're tying up your money for 5 years to lose money. That's what's happening. Look at 3 months. If you go buy a 3-month T-bill, you're at 0.03%. 3 basis points. What's the point of that? I mean, that's ridiculous. Okay, so you say, all right, I don't make enough money on T-bills. Let's go to a CD. Well, here's a 1-year CD, and the highest rate there is 1.05%. So obviously not as safe as a treasury. CDs have to pay more than treasuries, of course, but you're still at 1.05% for 1 year on your money. You can kick it up to 5 years here. Let's go to the next tab, 5 years, and you can get 1.75 from Barclays, according to this. So if you're still under 2%, holding your money up for 5 years, that's not a good rate of return from a typical investor standpoint. So maybe you want to go into bonds or stocks. I definitely don't recommend bonds right now. Interest rates have nowhere to go but up. So you say to yourself, well, let's look at the stock market. This is the Graham and Dodd PE for the S&P 500. The PE ratio, you're talking about price to earnings ratio, is important when looking at stocks because it tells you how much people are willing to pay. So let's say my stock was $60, whatever stock, $60. In the last year, they made $3 in earnings per share. So that correlates to a PE ratio of 20. So for every dollar of earnings they have currently, people are willing to pay 20 times that level of earnings to own that stock. You might think that that's pretty high, and in fact it is high. A PE ratio of 20 is on the upper boundaries, and you can see from this historical perspective here, every time it goes above 20 or 25, something bad happens. And this is a nice little chart. Now if we go to the updated today's chart, because if you look back here, this ends at 2009 where it's going back up, but this is today. This is the Shiller PE ratio today, and as you can see, it's at 24.37. So that's the market. That's not just one stock, that's the market of stocks. 24.37. Look at every time the stock market goes over 20 on a PE ratio. Every time it goes over 20, it goes back below 10 at some point in time before it rebounds again above 20. So here, above 20, below 10. Above 20, below 10. Above 20, below 10. Above 20, below 10. Way above 20, and we have not yet gone back below 10. We bounced right here. We probably should have kept going down, but guess what happened right here? A huge bailout and printing of money, and we got to fix the economy, and so that created a spike. So what's the stock's growth right now? Where are we growing from? Are we growing from people having all kinds of money and unemployment rate low? No. People's wages are stagnant or going down. People are broke. College kids coming out of college can't find jobs. I mean, what is the economy based on right now? Debt. That's the answer, and that's what's boosting the economy. Not the middle America buying things. That's not what's propping the economy up. And like I said, right here to 24, we have not gone back below 10. The stock market will go back below 10. Now, this Shiller PE ratio is not for day traders. It's for long-term investors who want to predict long-term trends. And so when I say silver as an option, it's because the long-term trend for me is bearish on the stock market based on the macro events, based on the PE ratios, based on what the government has done, what the Federal Reserve has done, and there's no good investment out there. I mean, some real estate's good for a couple people if it suits you, if you can get in thin. Like I said, I did a whole video on that. But what else is out there for other people? Treasuries, CDs, bonds, stocks. I mean, unless you're running your own business profitably, which could work, you don't have a lot of options. Silver and gold give you options. Now, someone's going to say they don't pay a dividend. That's right, they don't. And I'm okay with that because I'm not investing my wealth into silver to be paid a dividend. I'm investing it to protect it from what I believe is coming up. And that's a huge loss of wealth in the rest of the economy. It has to. I mean, just based on everything we've seen. So again, I'm more concerned about the return of my capital than the return on my capital. And that's why I invest in precious metals, silver and gold. This is Heavenly Prepper, preaching and prepping.